Hello traders, this is Michael Huddleston with a Pro Traders teaching session for September 8th, 2012. Alright, we are looking at an example on how we can use open interest, key support and resistance levels, and major shifts in market direction. So this will help with building a higher time frame premise. This will help with a risk on, risk off scenario. Okay, but a lot of the concepts that we're going to talk about here will be further amplified in greater detail in the trading plan development series released this week, Wednesday evening around 10 p.m. Eastern Standard Time. The video should be online. But for now, we're going to look at the dollar index, and we're going to show how a few key concepts that I've used for a number of years just continuously delivers outstanding results in terms of prognostication, and everyone's been pretty much blown away by the accuracy on the walk forwards in the analysis, and the high we called in the US dollar, and the bullishness in all of the other foreign currencies as a result. So I figured I'd start the whole teaching series in the Pro Traders Club 2012-2013 series with a means of showing you how I look at the higher time frame macro view and how I digest this entire market and look at it from a modular standpoint, and then show how they all dovetail together to give you a cohesive and panoramic perspective on how the market should or should not trade. And obviously we're looking at the dollar here. This is a weekly chart, okay, and I want you to draw your attention to this old high back here. Alright, this happens to be 83.55, okay, and obviously right above it would be the full figure 84. Now notice this high here down to this low. This was the dominant price swing, okay. So as price retraced deeper and higher up into this low to highs range, okay, think about what we covered in the webinar inside the range. Okay, same concept, but we're just using it on a very higher time frame basis. In this case, it's the weekly chart. So we would be looking for the 83.50 and 84 levels to be very significant price points to be monitoring for possible resistance to come into the marketplace. And you saw there was a short-term high here, price traded down, and then one more time rallied up to the 84 figure. Okay, now let's take a look at the daily chart on the futures contract of the US dollar index. Okay, and you can see that here's that high. We ran right up into that 84 figure, traded away, and then one more time rallied up to it, and just a small little violation above the 84. Okay, but here's what I want to teach tonight. If you went through my core concepts video, I've rather quickly brush through the concept of open interest. And open interest is a measurement that you get in the futures market that is very strong in terms of studying the actions of smart money. Okay, and open interest is really a measure of the open interest of traders' positions that are open at any one particular time. And if the open interest is increasing, okay, while market moves are underway, it's a confirmation. Okay, and it's just like volume in a sense. And the guys that follow our thread, um, there is an interest in VSA, and I don't really particularly trade it, but I know a few folks on Baby Pips forum have had some success with it. But I'm not alien to the concept of volume. I just don't see um, any benefit personally for me to learn it, but it's not to say that you can't learn it and add it to your repertoire and your toolbox. But I do look at volume in the commodities market, and since I do trade currencies, the British pound is a commodity dollar. So if you look at here, we have these vertical bars down here. Okay, and each one of these vertical bars represents volume. Okay, this is an actual measurement that is tangible, it's real. Okay, there are contracts being measured here in terms of volume. For each one of these vertical bars, it represents the entire volume for that particular day. Now I want to draw your attention to the fact that we had this high here, and we had a higher high here. Again, banging up against that 84 resistance level in here. Now I want you to see that while we were rallying up, making higher high, higher high, higher high, you see, we got 1, 2, 3 higher highs. Note that the volume had been slacking off rather notably. Okay, we were not seeing increased volume. As we were seeing volume increasing here, this confirms the buying. Okay, new highs with increasing volume is good. Okay, that's confirmation. When we started seeing volume fall off, okay, while we're making a new high into a key resistance level, that is a precursor. Okay, so volume precedes price. Just remember this, okay? Volume precedes price. So if there's a lack of volume while we're making fresh highs or higher highs, that is not new buying, okay? That is liquidation. Now, here is the main point of this teaching this week, okay? I want you to notice this heavy black line in here. This represents open interest, okay? In the futures market or commodities, the most dominant entity that short sells in the marketplace is the commercials. Okay, the commercials are the large institutional investors and traders. Okay, they have a real tangible need and basis for being in these markets. They either produce, manufacture, or buy or sell commodity markets themselves. And because they have a trained, accredited staff that are really just keeping their finger on the pulse of real supply and demand factors in the marketplace, they're always going to have more insight than we are as traders. Okay, so we as retail traders or small speculators, we are not the dominant player in the marketplace. Okay, so we can only make money when the large entities move the market themselves, and then hopefully we can ride on their coattails. Well, open interest is only going to rally up, or increase rather, okay, if there is heavy net selling, okay, or short selling. Because the largest entity in the marketplace is the commercials, if open interest is increasing while we are in a trading range environment, okay, you can see here we have a rather clear discernible trading range in here, the 84 down to the 82, 81.50 level in here. So price was trading within a small consolidation or range, okay, but here's the key thing. we're trading up against a predetermined higher time frame resistance level. So we would be expecting this to present resistance. Now, we don't always know if a resistance level or support level is going to maintain price or reject price, okay? But this insight with open interest is going to give you more or less an x-ray view on what the smart money is actually doing, okay? So now watch what's happened. We went into a consolidation after hitting the 84 resistance level, okay? So now when we start going into a range like this, you need to go and look at what open interest is doing in the commodity market, okay? Open interest increases dramatically. See how that large increase in open interest takes place? Okay. Now look what also happens. We make a higher high here, but we don't see an increase in open interest here. Okay. So we have two things that's being told. Number one, there's a huge increase of net selling or short selling. And our understanding in technical analysis is that the largest dominant players in the marketplace that short sell are the commercials, and they are generally more right than they're wrong. Okay, and they have a very long-term to intermediate-term perspective on the marketplace. So when you see these things set up, number one, they don't happen right away. Two, they take time to unfold, and it gives you a lot of opportunity to strategize and plan on how to take advantage of this. So we could be looking for a potential top in the marketplace. Now remember, we called the 84 high in the dollar. Okay, before it actually started to turn and fall off rather sharply, we called 84 as the high. And this is the reason why. We saw open interest increase dramatically. That's commercial short selling. Open interest diverged with new highs. So as this was going up, okay, and price was rallying, if we would have continued to trade on up and open interest would have maintained a higher cumulative line here, that would have confirmed buying if volume also was increasing. Okay, so you got to blend three things here: price action with support and resistance, volume, which was falling off, it wasn't very strong in terms of volume, and open interest had failed to make a higher high in here. Okay, so we had a rather dramatic increase in open interest while in a range rather at a key resistance level. So those clues were my way of determining that this was probably going to be a intermediate to long-term high in the dollar, and that's going to translate into bullish prices in the foreign currencies. So now, if this is what's happening in the dollar, we should see the mirror image in terms of smart money action in the other currencies. And let's take a look at those now. First, we're going to take a look at the British pound. Okay. And we're going to look at the 154 level. Okay, 154. Now each horizontal line in here represents essentially 200 points. Okay, so here's 2, 4, 6, 8, 10. Okay, so here's 150 to 160. So each horizontal line represents 200 points in terms of price movement. Okay, so we're looking at the 154 level in here. You can see how that was a very clear, discernible level of support. Okay, so there's our higher time frame support level. Okay, so we know 154 is a solid number. So let's now drill down to a daily. Okay, here's the 150 level. 2, 4, 6, 8, 10. Okay, so again, each horizontal line represents 200 pips or 200 points in the fact that we're looking at the futures market here. Note that on that 4 at 154 figure, okay, we saw price find support there. Okay, we saw price find support here and short-term resistance in here as well. Okay, so we do have a very discernible price range in here, very tight consolidation or trading range. Now watch what happens. Here's our cumulative line. This is open interest. Now at this time, open interest jumps up in the dollar. Why? Well, we know that the commercials or the smart money are heavy net sellers in the marketplace. They are the market, okay? So if they're heavy net selling or short selling, that means they're bearish on the dollar. What do you think would happen in the British pound that same time frame? Because they're going to be diametrically opposed. Now, think the dollar's going down, the British pound's going to go up, or it should go up. Let's just put it that way. Well, we're in a trading range environment. Look what open interest does. Boom, huge, big drop like that. That is a classic telltale sign that you are now looking at a intermediate term or long-term low forming in the marketplace. Now, I will grant it that it took a while for this thing to start moving on up, but nonetheless, it's been bullish versus going lower like everyone else was talking about this pair back here. Um, I don't like talking about these things right when they happen because number one, things have to take place on a short-term time frame also to get you in sync with the move. This is just a very higher time frame macro selection tool. And because it's a very because it's a higher time frame selection tool, it's very forgiving in terms of timing because it gives you an opportunity to strategize again, prepare, and set up your orders for looking for short-term retracements and support levels to be buying this particular pair. So let's take a look at the actual move itself. Okay, here we have the trading range environment that we're within. Okay, here's the low up to the high. Note the optimal trade entry that takes place right at that 154 level. Okay, runs up. Now all you have to do is start looking for opportunities to look for entries on OTEs. Here goes another one. Here's another one. And all in here, look at all these. Okay, go back through your charts on a 15-minute time frame. Okay, and look at how many times it's given you optimal trade entries to get in sync with that higher time frame premise. Okay, I've been quiet on the British pound commentary because there's a real reason for that, and you're going to see that on Sunday's market review. But this is how you want to be trading. Okay, you want to be looking at the higher time frame macro view. Okay, and there's usually 3 to 4 major shifts that take place in a calendar year. Okay, now the shift may take place, in an area between 3 to 4 months. So again, I don't want to teach everything in this concept here, but I do want to introduce you to it and kind of get you excited about what's coming up on Wednesday. But you can see how it generally gives you the higher time frame premise for you to be focusing on your trading plan as a bull. You don't want to be necessarily a hardcore bear in here because everything's engineered to go higher. Okay, now let's take a look real quick back here in June, July. What were the commercials doing at that very same time? Let's go back to the British Pound weekly chart. As you can see, they were net long. Okay, they were net short here, but they immediately jumped up here real quick. Okay, now why would they do that? Why would they do this rapid increase of net longs? Because that's also showing you what? It's a rapid reduction in shorts. Think. Remember, if open interest is dropping, that means that they are not holding on to their shorts. They're dumping their short selling. Okay, they're covering. And you see that happening with the net traders position here on the COT. They swing rapidly from net short to net long, and here's your buy signal. Okay. Note also that this is happening at a time when we are trading at 154, which is a key support resistance level. Okay. Also note that we have this low to this high, and there's your optimal trade entry as well on a weekly chart. Okay, so you see how these things start to dovetail nicely, and it takes a lot of ambiguity out of the marketplace, and it gives you a very clear, discernible way of attacking price action and how you can find setups that more or less get you in sync with the higher time frame dynamics. Let's take another look at how this is effective, and we're going to look at now the euro. Okay, we're looking at the 120, 120.50 level in here. Okay, and I put this in video, and I more or less I guaranteed you, and I said that in the video that if we get down to that 120, 120.50 level, I guarantee you we're going to have something down there that's going to be very nice in terms of an opportunity to trade. Okay, and here we are, we're 800 pips or so away from that particular price level. Okay, so we went down to 120.50. Um, I knew that it went there. I forgot exactly what the low was, but we're going to take a look at it in a moment. But as price swung down here, okay, look at what was going on with the commercials. Here's their ridiculously net long position. Here's the basis zero line. This delineates whether you're net long or net short on the commodities. I'm sorry, the commitment traders report. They have been accumulating massively on the euro as they got closer and closer down to that 120 figure. Okay, so this is the reason why I was telling everybody, look, I know everyone else is bearish, okay, and they think the euro is going, to hell in in a handbasket. The bottom line is that there was a lot of things technically saying that this is probably going to go up. Note at the same time that this line here, okay, and I don't want to throw too much at you, but this is the market sentiment, and they were basically saying about 22% were bullish. Okay, so that means majority of everyone that was reporting their sentiment was 80% or so bearish on the marketplace. And whenever you see that type of event, when the commercials are saying no way, I don't think so, it's going to go higher, bottom line is that you can expect higher prices. Okay, so now let's take a look at the daily chart and see if we have any clues there, because remember, we should see a trading range at support and open interest drop. Okay, we have a low formed here, we have a lower low formed here as we got down to that 120.50 level. Okay, note that we also, if you want to be looking at indicators, we have a bullish divergence in the stochastic. Okay, so if you like looking at indicators, now these are going to suddenly have a magical property to them where they look and operate as you would hope to see them operate. But notice we had volume falling off. Okay, see how the bars were going lower, 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 lower as we made lower lows. Okay, that means that there was no new selling. Okay, no new selling. But now watch what happens here. See this dotted line? See that dotted line right there? This is actually a seasonal tendency for open interest. What? A seasonal tendency for open interest? Absolutely. Okay? I am absolutely a big fan of seasonal tendencies in the marketplace because they're generic. They happen in everything. Okay? Everything that's tradable has a seasonal tendency. Okay? Because it's based on the particular business model for that asset class. Well, this right here says that we generally see a reduction rapidly in open interest at this time of year, in June, July. Okay, this heavy line here is the actual open interest. Okay, here's the actual open interest. Now watch what happens. Boom! You think that's a huge reduction? That's absolutely enormous. Okay, so now look what's going on. They're selling, they're heavy net selling, short selling, short selling, short selling, short selling, and now they don't want to be short selling anymore. So they rapidly start covering. Okay, when you see that at a time when we're approaching a key resistance or support level, we can expect to see the market put in a low. Okay, now it could be an intermediate term or a long-term low, but either case, it's a very significant low. Now, I tweeted that this presentation would give you the insight on finding 500 pip price swings, and I'm not exaggerating when I say that. Okay, I want you to go back over and look at how much the market moved in the dollar. I want you to look at how much the market has moved in the British pound, and now we're going to look at the euro. Okay, so we had open interest fall out of bed. Okay, that means there was a rapid reduction in short selling by the commercials. That means what? That means that they're bullish. Okay, and that happens in June, July. So now let's take a look at the euro. Okay, here's your June, July time frame in here. Okay, price trading down to that 120.50 level right in here. Okay, price rallies up hard. Okay, you don't have to chase that. You do not have to worry about catching the low. You want to wait for the dagger to fall, stop quivering, then gingerly go over and pick it up. Okay, well, by looking at the low to this high, we measured this and we had this in our analysis in video pre-action before all this unfolded. Okay, we called this market low here. We expected price to trade on up, and we were looking for these highs back in here and this high back in here as well. Okay, and if you look at what that did, just for example, real quick, I don't want to give you too much again. Not that I'm trying to be selfish, but I just want to hold a lot for the teaching module on the trading plan development series. Well, you can see the optimal trade entries in here. And 121.50 would be a very handsome level to get it long in. And if you took that with the expectation that we would see these highs in here retested, from that point here, it's 593 pips to this old high back here, which we saw trade to. It was 660 pips. Okay, and you can start to see here where I had notations for where I anticipated price to trade to. It just traded up into that area here, and we're going to cover more about this box and all that on tomorrow night's weekly market review. Let's give one more example, and I think we've pretty much accomplished what I wanted to show tonight. We're going to look at the Canadian dollar, just to show you that it does trade like this outside of my normal pairs. Alright, we're going to look at the Canadian dollar. Okay, we have old support here at 96, and here we have it here. Note this low up to this high. We traded down into optimal trade entry at 96. Okay, so we have a very key high time frame rather support level. Okay, in the form of 96. Do you think they're rapidly covering their shorts here? This is the commercials. Okay, do you think they're rapidly decreasing shorts? I think they are. Okay, so now watch us go over to a daily. Okay, we have price come down into the 96 support level. Here's a low up to high, optimal trade entry in here. So we have a small trading range in here at a time frame when what? Open interest does what? Boom! Falls out of bed rather sharply, does it not? That is your smart money clue that this is now priced in the low. Okay, and then you can see where price is traded up. And let's take a look at it on our futures charts. I'm sorry, our commodity charts. Now looking at the Forex charts, we're going to be looking at the U.S. Canadian pair. Okay, so in other words, if the commodity market on the Canadian dollars futures market was bullish and was going to go up like that, our US CAD pair would be a mirror image. In other words, it's going to be inverse. So if it's bullish Canadian dollar on the commodity market, it's going to be bearish on this pair. Okay, so now watch how this works in reverse. Here's that high down to low. Optimal trade entry in here. Okay, consolidation. And then a smaller short-term optimal trade entry in here. The one we talked about as an inverse on the futures for a buy. Now here it will reveal itself as a sell, because again we're looking at the US CAD, so it's going to be reverse. It's just showing you that the Canadian dollar should be rallying against the dollar. So the dollar is dropping while Canadian dollar is rallying. Okay, and you see that take place here. And if you are a US CAD pair trader, just getting here at the short, at the sweet spot, down to the old low here, there's 600 pips. Okay, so I would counsel you to take a look at open interest in the commodity markets, because you can't really get a better gauge on smart money than that. It doesn't limit itself to just that. You guys heard me talking about the stock market averages and how that I anticipated those particular averages to go higher, and everyone seemed to be shocked and amazed by it. Let's take a look at what I saw in that. Now it's going to be a little bit spotty because we just transferred to a new contract month for this, but you can see the open interest fall out of bed here. Same thing took place in the previous contract month on the Dow futures. So we had a huge reduction in open interest here. Boom, dropped down hard. That's bullish. That's short covering on the commercials, and you can see we since traded up about 1,000 points in the Dow. And now let's take a look at the S&P. Same thing here. Consolidation, rapid reduction in open interest. That means that they're short covering right now, and it makes a rather dramatic increase in price. And you can see that here. This is what we were calling, and why we were calling it bullish as we were. Again, the Dow, the same thing. We saw this is a continuation to run up to old highs in here. And the NASDAQ, same thing, we were expecting price to run up and be bullish here as well. So all this translates to a risk on scenario. Okay, risk on scenario. And let's look at the NASDAQ for its open interest insight. And you can see the open interest fall out of bed there as well. Rapid reduction, that means they're covering shorts. They're only going to cover shorts if they expect higher prices. And you see that unfold here in the indices. So that's the reason I was bullish, and we had this recent quarterly price swing on the higher time frame macro view, and what tools I used to more or less give that analysis to kind of like show you where we were going to see price trading. And again, because we see that 3 to 4 times a year, it's basically like a quarterly shift in the marketplace. It's very generic, it's very macro in terms of universal application, and you can do that with your regular commodities. Because we saw this thing unfolding like this, we talked about the commodity market being bullish. You can see how the commodity markets have maintained what we've called a couple weeks ago bullishness. It's still rallying on up. Okay, same thing in here. Optimal trade entry. Everything looking for a risk on scenario. So commodity markets should be going up, and that's the reason why wheat went up to the tune of $15,000 to $20,000 a contract if you were buying that. Soybeans, same scenario. $15,000 to $20,000 a contract if you were going long in that. It's we talked about gold. Everybody seems to be surprised now. All of a sudden, gold's breaking out. Well, we called gold going up before it was obvious to everyone else. And let's take a look at what that's done. And I'm not trying to brag, okay, but we knew that gold was going to go up here because the risk on scenario, okay, and gold has now since rallied on up. The energy markets, we talked about crude oil. Okay. Again, crude oil rallying on up. So again, I mean, I don't want to beat it to death, but you can see how looking at the commodity markets gives you an X-ray view, if you will, on how we can measure risk on, risk off scenario. So obviously, if the dollar is bearish, that is a risk on, and if the dollar is bullish, it's risk off. Okay, and just look for the mirror action in your foreign currency markets. And with that, guys, I wish you good luck and good trading.